Welcome to Yahoo Finance's flagship show, The Morning Brief. I'm Madison Mills. Let's get you the three things you need to know today. First up, U.S. stock futures falling this morning after stocks closed out 6 consecutive days of gains on the brink of a bull market. For investors wondering if the rally's run its course, JPMorgan CEO has a warning. Jamie Dimon telling shareholders at the firm's investor day that he thinks markets are too complacent amid a slew of mounting risks, citing tariffs, credit spreads, and geopolitics. Plus, Home Depot out with results posting worse than expected same-store sales for the quarter, down about 0.3% from a year ago. The company did, however, keep its guidance for the fiscal year. Management signaling they will maintain prices, shares reflecting a better-than-feared reception on Wall Street. And a big win in Washington for the crypto industry, stablecoin legislation overcoming a procedural blockade in the U.S. Senate, marking a major victory for the crypto industry after a group of Democrats had dropped their opposition. The industry-backed regulatory bill is now set for debate on the Senate floor with a bipartisan group hoping to pass it as soon as this week. Democrats had initially opposed the bill due to concerns over President Trump's crypto dealings. JPMorgan CEO Jamie Dimon warning of complacency in markets, citing a slew of risks on the horizon. The commentary comes after U.S. stocks closed out 6 consecutive days of gains on the brink of a bull market. So are investors underpricing risks? Joining us now, Sonders, Charles Schwab's chief investment strategist. Lizanne, great to have you on this morning. Talk to me about Jamie Dimon's commentary. Is he right? Are investors underpricing risks to come?
I do think there is some complacency. You did see an incredible whipsaw, obviously, in the market, but also in sentiment. But even at the early April lows, you hadn't quite gotten the full washout in sentiment. You saw it in the attitudinal measures of sentiment, the survey data, a metric like American Association of Individual Investors, which does admittedly skew older on the spectrum. And you did see a bit of a washout, but it was not corroborated by behavioral measures of sentiment. What we did see, and for now, it was the right move, that buy the dip mentality. The rally has been driven in large part by things like retail favorites and meme stocks and non-profitable tech. So I think that whipsaw back higher, much as we had some washout in sentiment, we may be at that point where the setup from a sentiment perspective suggests that the market could have some downside if we get a negative catalyst. And that's really the best way to think about this market. It's hard to judge it based on what policy announcements are going to be and when they're going to come. That's a fool's errand. I think it's the technical and sentiment setup that's important. And we probably do have some complacency back in the mix.
So that's really a smart framework for our investor audience. We could get downside if we do get a negative catalyst. What is that negative catalyst that you are most on watch for coming up?
So it could be that the benign inflation data that we have seen simply reflects the fact that with postponements and delays, we have had, in terms of the inflation data and the reference period, the period through which we got CPI and PPI data, really only had an average effective tariff rate of 4%, maybe close to 4.5% versus the 2.5% that existed before. So not a big delta there. I think if we were to start to see indications of a pickup in inflation, that could be a negative catalyst. That would put maybe the Fed further on the back of their heels. And/or I think probably the bigger risk, although I don't see it imminently, but on the subject of what could be a bit of a tipping point, would be a more rapid deterioration in the labor market, particularly given that that's what the Fed has the closest eye on right now. So at the economic level, I think those could be problematic. And we are starting to hear from companies, not Home Depot today, but Walmart raising prices. We saw it with Subaru today. So I think it's the feeder into the inflation side that represents maybe the most obvious near-term risk.
And to that end, this morning, one of the great charts you posted was the divergence we're seeing in the inflation data and consumer sentiment really falling off of a cliff. What does it take to kind of shift consumer sentiment into consumer behavior that could then lead to things like cracks in the labor market that you mentioned?
Yeah, so this is part of the discussion that I think is a valid discussion these days as to whether the soft data is overstating weakness in the economy. And that would be all the survey-based data, consumer sentiment, consumer confidence within consumer sentiment. To your point, Madison, you've got the inflation expectations piece, which has not at least yet been corroborated by what we're actually seeing in inflation. Now, of course, inflation expectations are forward looking. The inflation data we have in our pocket is backward looking. And expectations are important. They don't necessarily represent a perfect guide for where inflation is going to be, but inflation to some degree, as is the economic backdrop, is driven by confidence. It's driven by behaviors, anticipatory behaviors on the part of consumers, not to mention the fact that the Fed pays attention to inflation expectations. And whether it's 1 year or 5 to 10 years, they have absolutely spiked. That could start to change behavior. If it's not ultimately corroborated in the next month or two by the actual data, then I would expect to see inflation expectations retreat a bit. I think the most likely scenario right now, more broadly, in terms of the really weak soft data and the more resilient hard data, is probably a bit of a convergence between the two. Some weakening in the hard data, but maybe some improvement in the soft data, as opposed to one solely giving way to the other.
And that's interesting, too, to hear that it may look like a little bit of a slow burn to the downside in the hard data versus kind of an immediate crash off of a cliff. Right. How do investors position for that? What does that sort of look like in terms of the action when it comes to equities?
Yeah, so in early April, we neutralized our sector recommendations, meaning that we have three categories for sector views: outperform, underperform, and market perform. Market perform being neutral. We've neutralized all of those right now, and think the better way to approach navigating within the equity sphere, the domestic equity sphere, is at the factor level. So we continue to have a high quality emphasis on factors: strength of balance sheet, stability in profit margins. Also, sort of that low volatility segment of factors when you're in a weaker market backdrop. That gives way to more of those momentum type factors when you're in rally mode. But to the extent we go through another period of volatility, that lower volatility factor tends to work in your favor. And I think really important in terms of that factor emphasis, if you're looking for opportunities down the cap spectrum, you absolutely want to stay up in quality down the cap spectrum, because in the small cap space, you still have the predominance of non-profitable companies, zombie type companies. And I think the risk down the quality spectrum is even more significant when you're in that smaller cap space relative to the larger mega caps.
Yeah, it's a great overview, Lizanne, and we're taking a look at live images right now of the president speaking to reporters on Capitol Hill, and obviously top of mind for him right now is that tax bill. I've had some sources telling me throughout the year, don't worry about the market volatility. As soon as we get tax cuts and deregulation, we're going to see a huge rally in the second half of the year. How are you thinking about that?
So I think there's been a lot of sort of misrepresenting, and I don't mean by the administration specifically, but in general, this idea that these are huge, brand new tax cuts. That's the stark difference relative to 2017. In 2017, they were big new tax cuts on the corporate end of the spectrum, on the individual end of the spectrum. Now, what we're talking about, for the most part, is an extension of those tax cuts. So it's not quite as sweet as the candy was for the economy in 2017. Now, on the other side of that, if there isn't passage of that extension of 2017's tax cuts, which have on the margin some additional cuts, the economic hit is significant. So again, we're talking about the delta here of not getting something done as a big economic hit, getting something done as eliminating that big economic hit. So I think we have to frame it very differently relative to what was going on in 2017, because it was big new stimulus at that time. This is more about the extension.
More of a removal then of a potential headwind for the market. Lizanne, thank you so much for your time this morning.
My pleasure. Thank you. Thanks for having me.
Well, most hard economic data showing the U.S. economy, it's been holding steady, a signal that's at odds with how Americans may be actually feeling. University of Michigan consumer sentiment hitting the second lowest level on record in May, even as inflation continues to cool and the unemployment rate hovers near a historic low. Joining us now to dive into that disconnect, Meredith Whitney Advisor Group's CEO. Meredith, great to have you here. In a recent note, you wrote that over half of U.S. households are barely holding on, and yet at the same time we have the employment data holding up, this so-called hard data holding up. To what extent do you think that there could be a risk out there that is similar to that 2008 housing market crash that you predicted?
I don't think there's a risk of there's clearly no risk of a housing market crash. Consumer households are as unlevered as they've been in 40 years. So leverage is the lowest it's been in 40 years. But I think if you dig down into how consumers and households are really doing, over 50% of households have already been through their first recession. That was 2 years ago. And I think they're going into their second recession in 3 years. So 52+% of households are living paycheck to paycheck. And they've really been squeezed by the cumulative inflation of higher food prices, higher insurance costs, higher costs across the board. And when you look at these households, a great number of these households are employed in the sectors that have been under the most pressure. So clearly, aggregate spending has slowed, definitely in travel, leisure, and hospitality, and in retail. And I think that's where you're going to see pressure in terms of job losses. But I think you'll also see pressure in general from these households have no wiggle room in terms of inflation. And I see inflation across the board. So let's talk about what Walmart said last week, which was that they try to maintain prices on grocery, but they put increased prices in other areas of the market. I think grocery prices are going to go up again. So one thing that has not been discussed broadly at all is immigration and ICE raids. And recently, a private equity company said that they see cracks in the economy because workers are not showing up work for fear of ICE raids. So there have been ICE raids across the board at areas, workplace areas. And when employees don't show up to work, revenues suffer because in the instance of quick service restaurants, there's no one to man the kitchens. So I think you're going to see revenue pressure in those areas. They'll cut jobs just to maintain profitability, and then you're seeing more consumers squeezed.
And Meredith, you just laid out so many great points in terms of risks to the consumer. I have here existing inflationary problems, the fact that people have already undergone several recessions across U.S. households, tariff risks related to pricing for consumers, and then, of course, immigration. One thing that is top of mind for me, and you note, is that the wealth effect could be making it look like the hard data is better than it actually is, because the richest consumers can make it look like the economy is doing okay as long as they keep spending. To what extent is that potentially at risk, given the downward pressure that we've seen in the stock market, and how that could potentially lead to a pullback in spending amongst the wealthiest individuals?
Madison, it's a great point because the aggregate, the hard data is so skewed by the high end. So the high end controls over 2/3 of all spending, and so you get a difference between an American Express consumer that has lots of discretionary spend, and you would think the economy is doing great, but for small businesses, and then you look at a Capital One or a Bread Financial, and consumer spend has materially slowed. And you can see it in part in the credit card data. Balances aren't really growing very fast. So in the fourth quarter and the first quarter, balances of home equity loans grew faster than credit card loans. So in many cases, the low end and some of the medium end are maxed out, and so they're drawing on the equity in their homes to either pay down debt or get a breath of liquidity where they really need it. And one thing that you didn't ask me about is, the older consumers are really stretched. So the seniors are really stretched. So a lot of times people think the boomers, or oftentimes people think the boomers are the richest generation, but that's skewed to a smaller portion of that generation, and seniors are taking on so much more debt, which is counterintuitive, because the older you get, the more conservative balance sheet you want to have. And so you can see, if you look closely, you can see real cracks in the economy at the household level, but you just have to slice the data differently than how the aggregate, the typical data points that most economists look at.
Right, and the data points that the Federal Reserve looks at. And it makes me wonder, Meredith, is the Fed at risk of missing a potential slowdown that could lead us to yet another recession, because they're not necessarily looking at all of these different data points that you mentioned?
Well, I think the Fed's in an incredibly difficult situation, because you're going to have inflation, which has not shown up in the hard data yet, and you're going to have real stress at the economy. So a slower economy, a more stretched consumer, higher unemployment, but inflation. So as it goes, as Jay Powell had said, whichever diverges the most, either employment or inflation, they'll attack the fastest. But I think inflation is going to diverge faster than employment. So they're going to be in a tough position to deal with both. And I think rates will go down slower than the economy otherwise, all else equal, would justify.
And to that end, I want to wrap our conversation with a look at the housing market and the impact of that Moody's downgrade on U.S. credit, concerns of the deficit, lifting the longer end of the yield curve higher. We had the 30-year above 5% on Monday. To what degree does the deficit risk impact home buyers, given how that impacts the activity that we see in the bond market?
Well, affordability has been very difficult for new home buyers, because you haven't seen, with rising rates, you haven't seen a commensurate drop in home prices. So you have higher rates and high home prices, which makes affordability really, really difficult. I think that a couple things will happen, are happening. You've had Rocket Mortgage said in its first quarter earnings that what happened in April, they have not seen since just after the great financial crisis in 2009, where you saw a confluence of high rates, volatility, and double-digit declines in mortgage applications. I mean, that's terrifying. So you have a really bad first part of this the spring housing season, the strongest spring. Spring is the strongest part of the home season. 50% of home sales happen in this. Over 50% of home sales happen in the spring, and I don't think it's improved much. So I think this is going to be a problematic year for housing. So affordability is one thing, and then the other issue is over 60% of homes are owned by households over 60, and they're tapping into home equity, which means they're not going to be pressured to sell. So you're in this frozen home market, and I think that's problematic. Now, one point I'm going to raise about that: the National Association of Realtors estimates that 18% of the GDP comes from the housing market. So that's going to put the fact that the housing market has been so weak this spring is going to put even more pressure on GDP.
Meredith, great overview as always. Really appreciate you making time for us this morning.
Thanks, Madison.
Coming up here on the Morning Brief, we're going to count you down to the opening bell on Wall Street. Plus, we'll bring you the 3 biggest takeaways from Home Depot's latest results and the Google I/O Developer Conference kicking off in California. We're going to go live to the ground to bring you everything you need to know. All that and more coming up on Morning Brief. Now time for some of today's trending tickers. We are watching Amer Sports, General Motors, and Apple. First up, Amer Sports topping first quarter expectations with revenue increasing 23% from a year prior. The sporting equipment company also raising its full year guidance as it continues to gain market share. The CEO saying they're confident in their ability to manage a variety of tariff outcomes. Next up, General Motors saying it will stop shipping cars to China from the United States as trade negotiations continue between the two countries. The automaker imported vehicles to China from the U.S. through its Durant Guild premium import business. A spokesperson for the company saying, quote, due to significant changes to economic conditions, we've decided to restructure the guild and correspondingly optimize GM China's operations. Shares down just a tick. Finally here, looking at Apple as China's iPhone exports fall to the lowest level since 2011 to the United States. Smartphone exports slid 72% to just under $700 million in April as tariffs disrupt the tech company's supply chain. Those shares down about 0.5%. You can scan the QR code on your screen to track the best and worst performing stocks with Yahoo Finance's trending tickers page. Well, Home Depot reporting mixed first quarter results. Revenue topping estimates up more than 9% from a year ago, but earnings falling short of expectations. Still, the home improvement retailer reaffirming its full year forecast. Yahoo Finance's Brooke DePalma here with the biggest takeaways from the earnings report. Brooke, what are you looking at?
Good morning. Well, certainly Home Depot reported this mixed quarter, but investors are saying this was actually better than what they had ultimately feared here. The company also reiterating how it plans to handle Trump tariff. Wall Street also impressed with that. Taking a closer look at the numbers here, that mixed earnings report did come in at revenue beating Wall Street's expectations. Adjusted earnings per share coming in slightly lower. Now, executives said that these results were in line with what they had expected, but they did see customers engage less around larger projects, and ultimately they also saw customers engage with smaller projects rather. Taking a closer look at same-store sales growth after 8 consecutive quarters of negative sales growth. Back in Q4, the company posted positive same-store sales growth. Now, this quarter in Q1, we're seeing that reverse. We're seeing that turn negative. The company ultimately alluding that to negative weather. Ultimately, TD Cowen saying in a note that they were encouraged once again by that better than feared same-store sales decline. Also, the company reiterated full year guidance, providing some optimism to the street here. Now, many on the street are also thinking that, hey, Home Depot is actually well positioned to handle President Trump's tariffs here. Some key takeaways that we're hearing on the call right now from Home Depot this morning is that more than 50% of purchases are sourced from here in the U.S. They also said that in 12 months, no single country outside of the U.S. will represent more than 10% of their purchases. And the key factor here, somewhat different than what we heard from Walmart last week, is that they have no plans to increase prices because of President Trump's tariffs. That's certainly providing optimism here on the street.
Yeah, Brooke, just about 30 seconds left, but that seems to be the sticking point when it comes to this print in terms of the analyst notes that I'm seeing crossing the wire here. How is Home Depot able to do that? What can you tell us about why they're able to not raise prices off the back of tariffs?
Well, what they're saying that they're able to do here is really work with their vendors, saying that they have a strong relationship with their suppliers, and they're really able to mitigate the costs when it comes to that. Ultimately, though, they did say that they still saw inflation when it comes to lumber. Of course, we know lumber mostly comes from Canada. That's, in negotiations right now. So it's sort of a wait and see. But they're saying here they have no plans to raise prices this year. Of course, so much up in the air still when it comes to tariffs.
Yeah, it's so interesting to hear them couple that with keeping their guidance as well. Brooke, thank you so much. Really appreciate you making the time for us this morning. We're going to have all your markets action ahead right here on Yahoo Finance. So keep it here. You're watching Morning Brief. We're gearing up for the opening bell on Wall Street. Looking like stocks are going to open in the red. Just a little bit of pressure here. You've got your S&P futures down about 0.3%. Your tech-heavy NASDAQ off about 0.5% in the futures market this morning. But we are gearing up for that opening bell on Wall Street here. You are taking a look at live images from the New York Stock Exchange and the NASDAQ this morning as that opening bell rings on Wall Street. The big question going to be what is going to drive the tape today as the tax bill comes into focus in Washington? Is that policy sweetener going to be enough to lead to gains in the second half of this year? Liz Ann Sonders of Charles Schwab telling me this morning that tax bill, it's just a removal of a headwind. It's not going to necessarily be a lift for stocks. Having said that, what are we seeing in the market action this morning? Taking a look at the major averages, you've got your S&P 500 still down about 0.3% here. Your tech-heavy NASDAQ off about 0.4%. Interesting data this morning. Taking a look at a note that just crossed my inbox, indicating that retail investors are getting back into this rally after already buying that dip throughout the month of April and experiencing nearly 12% gains on the platform Public. We spoke with the CEO early this week. Will retail investors continue to buy the dip is going to be a key question for us going forward here. And it is time now for today's strategy session. The question facing those investors: do you sell the rip or do you buy the dip? Our next guest saying the technical indicators are favoring the latter. Here to break it down, Adam Turnquist, LPL Financial's Chief Technical Strategist. Adam, great to have you this morning. I just mentioned some data indicating retail investors keep buying even at these levels. Are the retail investors right to continue to buy the dip?
We think so. When you look at the technicals over the last month, we had enough boxes checked on the capitulation on the downside. We got the extremely oversold conditions, indiscriminate selling. We had washed out breadth readings. And now on the other side of that equation, we have the recovery. And we think you are, again, checking enough boxes here to set up for a buy the dip playbook. We're seeing breadth thrusts off the lows, notable number of stocks getting back above their key moving averages, leadership, importantly, shifting to more cyclical sectors. We're seeing that in industrials breaking out to new highs, consumer discretionary starting to outperform as well. So we think that playbook aligns with more of a buy the dip backdrop for equity markets. It does alleviate some of the pressure of potentially retesting the lows from April. We think that's an unlikely scenario right now.
And Adam, what exactly should that dip buying activity look like? Like, is it all created equal? Is it across the index that investors should be looking? Is it specific to tech? What are the attractive corners of this market?
Just at the broader index level, we'll start there with the S&P 500. We did gap above the 200-day moving average last week, so that would be a notable spot where you'd see potentially some support if the market starts to fill that gap. And then at the sector level, we think with that leadership changing to more cyclical areas like financials, that's an area we have an overweight view on. Communication services, that's been a consistent outperformer, great fundamental backdrop, great technical backdrop. Those would be spots we'd be adding to positions right now on any type of weakness.
Is tech still defensive in this market?
I think tech is now more of a barometer for risk. And one of the things we were looking for in terms of that checklist to identify a sustainable recovery versus a bear market rally is tech participation. And not necessarily tech leadership, but we're actually getting tech leadership. We haven't seen semiconductors quite break out yet, but overall, the tech sector participating in this rally. And so far, early signs of some leadership there, certainly a great sign for a sustainable recovery here, given the fact that the tech sector is about a 30% weight in the S&P 500.
Yeah, and it's interesting because I'm also hearing some folks say maybe you look at the equal weighted S&P 500 given that sector weighting for tech in your S&P 500 more broadly. Having said that, I am interested in what we're seeing in the bond market. If we can take a look at yields for a moment, because it's interesting to see yields as a potential headwind for stocks, because you're starting to get a little bit more bang for your buck when it comes to the bond market versus what we're seeing in the stock market in terms of earnings. How are you thinking about bonds as a potential competitor to stocks?
Probably thinking about bonds a little too much. I'd classify that as what keeps me up at night, that category, because with the 10-year Treasury yield right around 450, there's not a lot of margin of error here when we're talking about a breakout above 458. That's a key resistance level for the 10-year yields. If we break that level, that would mark a further move out of this bottom that's formed over the last month or so and leave kind of 480 as the next area of overhead resistance. I find it hard to believe, if we're talking about a 10-year rallying up to 4.8%, that the equity market rally continues. We think that could spill over into some risk off sentiment and pour some cold water on this red hot equity market rally right now.
And talk to me then about kind of where you're seeing opportunity across the yield curve. Is this a chance for investors to get into the 30-year yield when you do see a little bit more of that yield as it hit 5% on Monday? Or should investors say that's a little too risky given the concerns about the Fed and growth going forward?
We think we're getting close to an opportune time to add duration right now, maybe not quite there yet. Again, if we start to see, for example, the 10-year break 458, we get 4.75, 5% type 10-year. That's a new discussion in terms of duration, and the same thing on the long bond through 5% or north of that would be an area that we'd start talking about adding duration. But right now, when you look at the front end of the curve, you don't really need to take a lot of duration risk to add attractive yields and attractive income for portfolios right now. So we don't think you need to go into high yield. We think you can stay within more of the high quality areas of the market, and you don't need that added duration risk at this point.
Adam, really appreciate you making the time. Thank you so much.
Thanks for having me.
Let's get to Yahoo Finance's Jared Blickery for a broader look at what's moving. Hey, Jared.
Well, hey, Maddie, we're a little bit down today, but if you remember yesterday, we were down even more, and it didn't seem to make a difference because we closed largely in the green in most of our major markets here. So we're seeing a little bit of a red on the board, and let me just show you the two-day here. Now, the S&P 500 and the NASDAQ 100, as you said before, this would be their seventh day. If they could manage to turn it into the green, this would be their seventh straight win. But I want to just show you, this was the comeback that we had yesterday. It was pretty impressive, and Bespoke Investment Group counted, and they saw that there was the seventh Monday of the year where stocks were down 1% and then managed to, or were just down 1%. And that's kind of illustrative of the volatility that we've seen this year. Let me show you a year-to-date chart, because the S&P 500 and the NASDAQ 100 are now within spitting distance. That's less than 3% from the record highs that we saw way back in February. And we're seeing a lot of breakouts, and some of these sectors that we're going to look at in a second are hitting all-time highs. But first, I want to get to the bond market. I've been tracking the 30-year, and the 30-year T-bond yield inched above 5% yesterday. And let me just show you the two-day view, because that was rejected. So we started, here's 5%. You can see right there, we got almost up to 5.04, 5.05%, and then it was a steady decline throughout the day. We're bouncing a little bit higher today, but critically still under that 5% mark. And that just seems to be a big psychological level that the market is watching. And I can even show you that on a 3-year chart. This has been a kind of line in the sand, and when the 5% goes above that, equities have tended to take a stumble until it goes back down below. And that's kind of what we've seen, the dynamic that we've seen over the last few days. I want to go now to the sector action. I mentioned some breakouts to new highs. Industrials underwater a little bit today, but let me just show you the year-to-date on industrials, because it hit a record high yesterday. That was the first record high since last November, and that was the first of all the 11 S&P 500 sectors to make a record high post-Liberation Day. So industrials kind of leading the charge back here. And also I want to show you what's happened since the market bottom on April 8th. And here you see a lot of green, even healthcare, which has really struggled. That's up 1.2% since that 4.8 bottom. But tech up nearly 30%. Consumer discretionary closing in 24%. Industrials, we were just talking about that too. So it's really been a cyclically driven rally that we've seen off of those major lows just 1 month ago. And it's hard to remember that it was only 1 month ago that we were looking at dire straits, and the S&P 500 nearly fell into a bear market at that time. Let's get back to the markets and one-day view here, please. And we are looking at Tesla. Tesla is the only Mag 7 stock that is in the green right now. It is up 2.3%. Here is a year-to-date chart. You can see it's still underwater, but up impressively off of these lows that we were just talking about here. And if I could just shift a little bit over to our leaders, here we have more red than green today. We are having a little bit of a pullback. What happens is what matters is what happens into the close. And I just want to focus on the iShares U.S. Aerospace and Defense ETF here. It had a very shallow pullback compared to the rest of the market after Liberation Day, and it has just rocketed higher. Had its 10th record high of the year of 2025 only yesterday. So this is one of the leaders that I'm looking at, along with the industrial sector. We went over Tesla, so I want to shift now to the futures market. Let's take a look at gold, not having an outsized movement, but what impressed me yesterday was only last week I was talking about a potential top in gold, and yesterday, it was kind of fighting back. It was the biggest day in 2 weeks, and let's see if I can find the ticker. It's up another 0.25% this morning, and you can see here is the M top that I was looking at, dipped below, but it looked like it was a false breakdown. So we are once again above that neckline, and technically gold is in a decent position, and it's just consolidating around this recent price area. Now, silver is also jumping, but I want to finish on the crypto market. The stablecoin bill arguably gave Bitcoin a little bit of a boost yesterday, along with the rest of crypto, but it's kind of struggling to get past those old highs that we saw in January. So it's right now under 105,000. The old highs are around 107,000. Almost hit that yesterday, but really close there. And if you can see, there we got a nice cup pattern that's kind of forming, and we might have a little bit of a handle as well. So it could take a little bit to break out. If we get a big catalyst, it could rocket higher, but it would be normal for Bitcoin to just kind of meander around over the coming weeks until it can finally gather the strength for that ultimate breakout. On that note, I'm going to actually send it back to, I guess we're going to break right now. So stay tuned, all your markets action ahead. You are watching Morning Brief.
Bitcoin is jumping, holding over $105,000 following the Senate, actually just below $105,000 after the Senate advancing a major crypto regulation bill called the Genius Act with a bipartisan vote. Here with the latest, our very own Jennifer Schomburger. Hey, Jennifer.
Hey, Maddie, that's right. The crypto industry cheering this morning after a bill to regulate stable coins passed a key procedural hurdle in the Senate Monday night, paving the path forward for a vote on final passage as early as the end of this week. Now, this bill had become a political football, with Democrats arguing it doesn't prohibit President Trump and his family from profiting off issuing stablecoins and didn't offer enough consumer protections. Those objections caused an initial vote on this bill to fail just a few weeks ago before senators regrouped. Now, while issues over consumer protections were addressed enough to get enough Democrats on board to support this bill, the bill does not expressly prohibit the president from issuing a stablecoin, noting that just executive branch officials and members of Congress would be prohibited from issuing a stable coin. And even with changes, last night's vote really came down to the wire, with Senator Elizabeth Warren taking to the floor with gusto, expressing the same concerns that Democrats have had over the bill not banning the president from issuing a stablecoin, as well as reservations over stability, protecting against stability in the financial system. Now, what exactly does this bill do? Well, the legislation requires stablecoin issuers to maintain one-to-one reserves in cash and cash equivalents. Issuers must disclose reserves publicly every month. Those with $50 billion or more in total issuance must submit audited financial statements annually. It also bans unbacked algorithmic stablecoins, guarding against a scenario, if you'll recall, we saw a couple years ago when that unregulated algorithmic stablecoin Terra Luna crashed, wiping out $60 billion held by consumers in just 72 hours. Now, the bill also closes that so-called tether loophole, subjecting foreign issuers to the same rules as domestic issuers, and empowers the Treasury Secretary to delist them if they're not compliant. The bill also prohibits big tech companies like Meta and Amazon from issuing stablecoins unless they can meet strict criteria regarding financial risk and consumer data privacy. Now, Maddie, the Senate is now going to debate this bill, and it will offer senators the opportunity to offer amendments. From there, they will vote on those amendments, and they will need another 60 votes, so 2/3 of that chamber, to gain cloture on this portion of the process before they can proceed to a final vote on this bill for passage. We could see that final vote as soon as the end of this week. Back to you.
All right, Jennifer, thank you so much, as always. Let's turn now to another major piece of legislation before Congress right now, the Republican-led tax bill, one that my sources tell me could add $4 trillion to the deficit over the next decade. What exactly is in this bill? Let's break it down. So the bill extends the Trump 1.0 era tax cuts, keeping the top income tax rate at 37% and adjusting brackets to boost take-home pay in 2026. The child tax credit, that's going to stay the same at $2,000, but get bumped up to $2,500 from 2025 through to 2028 before going back down and getting indexed to inflation. Now, state and local tax deductions, known as SALT, would be capped at $30,000, up from the current $10,000 $400,000 and would phase it down for those making over $400,000. Another key focus here, EV credits. They are on the chopping block. Most would end after this year, though some new models could still qualify up to 2026. And Medicaid and food aid facing new restrictions as well. Medicaid recipients would have to work or volunteer, and states would face tighter rules on funding. As for SNAP, also known as food stamps to some, the bill raises the age for work requirements from 54 to 64 and adds stricter eligibility rules as well. The bill is still facing hurdles in the Senate. Any final version is likely to look different from what I just laid out, but this is a clear window into House Republicans' current fiscal priorities. My sources reminding me as much as this morning that it is really important to note that this is just an extension of tax cuts that have already been in place versus something that is going to necessarily be a huge tailwind to the market and to consumers' wallets going forward. Well, coming up, we're going to get a preview of Google's I/O developer conference from a reporter on the ground, so keep it here for that coverage next. Alphabet investors eagerly awaiting the company's developer conference, Google I/O, which kicks off later today. They'll be watching for signs the company can maintain its dominance in search amid increasing competition, especially from AI. The stock underperforming the broader tech sector so far this year, but even with concerns around search, a big focus of the conference will be on developments around Google's AI offerings. Joining us from Mountain View, California is Yahoo Finance tech editor Dan Howley. Dan, great to get a sense from you on the ground what you've been hearing from this conference. What sticks out to you?
Yeah, Maddie, really the big thing we're going to be looking for is any kind of AI improvements to Google search. They've talked about how they're putting more AI elements into search. You obviously see AI overviews. That's those kind of AI summaries at the top of your search results. Doesn't always show up, but it's often a feature that you may see. And look, this is an important time for Google. We heard Apple's Senior Vice President of Services, Eddie Q, during Google's antitrust hearings say that the company had seen a decline for the first time in searches in the Safari browser, and the base search engine for Safari is Google. Now, there's kind of isn't it a thing? Basically, there's speculation that maybe Apple may be downplaying how Google's performing because they have a $20 billion deal where Google pays them to make Google the base search engine for Safari. And if the antitrust hearing doesn't turn out their way, they may lose that $20 billion. But that's neither here nor there. The main thing is that there's this perception that Google may be falling behind the AI competitors like Perplexity, like OpenAI, and ChatGPT. So you'll see a lot of elements of that. And then obviously, they compete heavily with Microsoft Azure and Amazon AWS when it comes to Google Cloud Platform. So we're going to be looking to see any kind of elements there when it comes to AI. They have AI in workspaces, but what else will they be adding? And then, last year they unveiled this kind of really wild project, Project Astra, which was basically a way of interacting with your phone and your AI, being able to see the world around you through your phone's camera and then provide information about that. So hopefully we hear more about that and where that's going. They do have a AR, VR agreement with Samsung where they're building a headset. And so you would think that they would kind of expand from there, though they do have competition in that space already. Meta offers its Meta Ray-Bans AI glasses, and Apple is reportedly working on its own glasses that may come sometime in 2027 or if not later. But clearly a lot of kind of competition in that space because these companies want to know what's next after the smartphone, and it could be these glasses, maybe not, but they want to make sure they're not left behind.
Dan, always appreciate your reporting. Thank you so much for making the time for us this morning. Let's get a check here on the major averages. Taking a look at stocks. Moving to the downside, you've got your S&P off about 0.3%, your tech-heavy NASDAQ off just about 0.5% this morning, dropping after 6 days of gains. Really interesting, though, I have a note in my inbox this morning on how retail investors are getting in and buying the dip this morning. I want to take a look at the sector action, though, that we are seeing in the S&P 500, just to give you a sense, if I can pull it up on my screen here, of what is moving to the upside. Really seeing a lot of positive momentum in consumer staples and utilities is the biggest gainer on the S&P this morning. Tech is the biggest loser. It's off about 0.8%, and that's why you're seeing that negative reaction when it comes to the NASDAQ. But let's flip the board over to the bond market here. Another potential headwind for stocks, that 10-year above that 4.5% level. That may start to look attractive to investors. Several sources telling me that you should look at the front end of the yield curve, but what does that do for stocks is a question. That's going to do it, though, for the morning brief. Join me here in the next hour for more analysis on Catalyst. Stick around.